Hello and welcome to a special coverage on budget with me, Ankur Mishra and Snehi Shah. Let's get started with the Finance Minister's announcements, whereby she presented much awaited budget for the upcoming financial year. At a time of global turbulence, Finance Minister has said the budget aims to make India self-reliant and accelerate growth. An impetus has been given to a tech, semiconductor, manufacturing and rare earth projects. In terms of macro numbers, the Finance Minister has said government has pursued fiscal consolidation consistently without compromising welfare spending. Let's listen into big announcements made by Finance Minister in terms of numbers, targets and tax reforms.
One of the main operational instruments for debt targeting is the fiscal deficit. I am happy to inform this August House that I fulfilled my commitment made in 2021-2022 to reduce fiscal deficit below 4.5% of GDP by 25-26. In RE 25-26, the fiscal deficit has been estimated at par with BE of 2025-26 at 4.4% of GDP. In line with the new fiscal prudence path of debt consolidation, the fiscal deficit in BE 26-27 is estimated to be 4.3% of the GDP.
Okay, well, that's a little bit of a snippet of what the Finance Minister had to say in terms of major numbers today, the capex guidance as well as the fiscal deficit path going ahead. But let's take it across to Sajit for the editor's take on the budget. What stood out, what hit it out of the park, and what missed to please the investors?
The markets may be disappointed with the SCT announced in the budget, but the policy measures which have been announced by the Finance Minister turns out to be a very prudent one, and this budget is a prudent one for quite a few reasons. The first one being it's very they have kept a 10% nominal GDP growth rate, which is pretty much in line with the street there. The street was looking for a capex growth, which is come at 12.22 lakh crores versus the previous 11 lakh odd crores, which is there. In the defense space, there is an increase in budget for defense capital outlay at 2.19 lakh crores compared to 1.8 lakh crores. So in capex, there are two things which have come in. One, capex in general, and the second one being the defense capex, which is there. And the third one is in terms of railways, where the growth is roughly around 10% in terms of capital expenditure coming for the railways there. So from a capital expenditure point of view, the numbers are pretty much good in terms of the expenditure that the government is trying to do. But it has its negative effects as well. The government is moving to a debt framework where the debt to GDP has been predicted or expected to be at around 50% plus or minus 1 by 2031. Now that basically means that because the government is looking at higher capex over a period of time, they are pegging the entire debt to GDP at 55.6%, which is slightly higher than what the street was expecting. The street was expecting around 55.2% of debt to GDP, which is there. And that would mean some additional 2 lakh crores of borrowing which is going to come into the markets in the next financial year, thereby putting some pressure on bond yields and on some of the banks, which will be forced to buy those bonds from the market there. So from that point of view, it may be a collateral impact that may come in there. But fiscal deficit at 4.3% is as per expected lines as compared to 4.4%. There is the finance minister, which is also looking at over 3 lakh crores of money coming in as dividend from RBI and the banks in FY27. She has also tabled the 16th Finance Commission whereby the entire the allocation to the states has been maintained at 41%, whereby there's some certainty of what the growth numbers are going to be. While the nominal growth is very conservative at this point in time of 10%, the numbers which are now coming in, like the numbers that came in for January of GST at 1.93 lakh crores, it shows that there is some buoyancy which is there in the market. There could be a chance that the buoyancy will lead to a higher tax collection going forward, because consumption is increasing after the GST 2.0 that happened in September of 2025 there. So overall, there has been some relaxations with respect to buybacks. There is some relaxation with respect to tax collected at source. There is also incentives for labor intensive export sectors, which is there. And from a PSU point of view, there's a high level committee which has been formed by the government to look at how PSUs can be scaled up. There is a scope which will be brought out by the finance ministry there, and then PSU real estate monetization is something which has come in. So overall, it seems to be a very prudent budget which has come in from there. The only disappointment for the street would be the STT hike, but that's understandable because a lot of speculation is going on in the market, and a lot of capital of retail investors are going into losses that could be stemmed now, and that can then be diverted into cash market, or for that matter IPOs, or for that matter into consumption or bank deposits. So that's, from that point of view, it seems to be a very well thought out calibrated move on STT, and that's why I think the budget is prudent which has come out.
In a long-term move, now the budget has decided to give tax incentives to entities operating from IFSC. From earlier 10 years to now, this has been increased in the current budget to 20 years in a 25-year window. Now, this also gives certainty to investors for concessional tax of 15% thereafter. And to discuss what will be the impact on GIFT City on that, we have with us Dipesh Shah, Executive Director at International Financial Services Centers Authority. Mr. Shah, welcome to ET Now. My first question to you is, how much of the impact of these announcements will be there with more and more offices coming to GIFT City?
I think this is indeed a very path-breaking announcement in terms of aligning the International Financial Services Center with the global best practices in terms of the competitive tax regime. And unless and until you bring the tax regime in line with the international best practices in an international financial services business, you can't get long-term certainty and predictability. I think what government today has done is exactly that. They provided the long-term tax certainty and the predictability after the tax holiday period is over. That tax rate also has been clarified and included in the budget, which is providing a lot of clarity to the foreign institutions who wants to do a long-term business into India. So from an IFFC perspective, I think this will generate a lot of new international financial services business, which could otherwise was also done from centers outside for India. And it will also generate large number of jobs in the financial center in India itself.
Okay, Mr. Shah, point taken. Talk to us about how this boosts the competitiveness of IFSC to bring it at par with global hubs like Dubai, Singapore, London, New York. Talk to us about what this does for the competitiveness.
I think what you see in the global financial centers is that they all provide a very competitive regime. For example, you have DIFSC, you have ADGM in Abu Dhabi, you have Labwan in Malaysia, you have Hong Kong, you have Singapore, and many such financial centers across. And if you see one factor which is really driving their business has been the very, very low tax or a very competitive tax regime that they have. In fact, most of these financial centers have a 0% tax regime, which means that if you are taking away or you are competing on the same footing, you also need a long-term tax certainty for the institutions coming in. The existing 15 years tax exemption, out of which 10 years were exempted, was probably leaving some uncertainty that what happens after 10 years. So with this 25 years, 20-year tax exemption, and then 15% post-tax perfectly provides the clarity that the foreign and Indian institutions who can do international business brings on table now.
Mr. Shah, I want to understand the impact clearly. How much of your talking has been there with the global banks and other funds? Do you think only tax was a deterrent, or there were other issues which still needs to be sorted?
I think if you really see from last 5 years perspective, what is the data emerging from the IFSC at GIFT City? So we have 37 banks now, and they have brought in $100 billion of banking asset size in GIFT already. And this all businesses, if you really understand from where they brought this business, you will find that majority of the businesses shifted from Singapore, Dubai, and various other financial centers, which was done for India, but from sitting outside. So I think the first level of success you can see from the banking asset size. I think the second success story emerged from the fund industry. A lot of them were operating from Mauritius or were operating from Singapore. And suddenly you find a lot of them redomicile into GIFT now. So we are almost 350 plus funds, 200 plus fund managers here, and almost $25 billion of commitments that they have raised, of which $12 billion they've already invested. So to answer your question, I think tax is one of the important factor. I agree to your point that tax is not the only factor, but unless and until you match the tax regime, it will be very difficult to move international institutions in your financial center. And probably today's steps really takes care of long-term certainty, as I said, and the predictability of the IFSC regime for the future growth.
Right. Mr. Shah, I just want to build up on that point. You said that, or what you meant rather, is that continuity or sustainability once this tax window gets over is also important. From what we understand, once this 20-year window is over, the tax is going to be at 15%. Do you believe that is going to continue to attract the players that will now be encouraged to come to IFSC? Post 20 years, do you believe that they will still have shop here, and do you believe that this is going to be a long-term sustainable trend?
I think it's a very valid question, a very important question what you raised. If you really see from the perspective of where globally the taxes are moving, I think the global minimum tax has come to around 15% is what has been floated globally now. And that's why government announcing that 15% tax regime for the IFSC really puts itself into the same position where the global financial centers would be moving in future. So I think the step of having 15% gives that predictability. And what's more important is it gives you a certainty that, after my holiday period, this is how I'm going to operate from the financial center.
Right. One more clarification I wanted to take from you, that budget has clarified that intergroup loans won't be treated as dividend for IFSC treasury centers. Was this actually a concern?
No, I think this is more in terms of ensuring that the businesses which are doing the treasury center management services, which means that when you receive a dividend in form of the investments, this was a step taken last year. But I think this year, I think the government rightly clarified the definition, as this is from the perspective that if it is between the parent and this is within the group company, then this will not be counted in terms of the deemed dividend, which is a very important factor for having those treasury operations in India, rather than having those operations done for Indian entities from say Singapore or other financial centers. So it was an important step forward.
Okay. And lastly, Mr. Shah, talk to us about your expectations from the budget. I'm sure the IFSC had a list of expectations from the budget. Tax break, yes, but do you believe that the budget ticks other boxes? Are you satisfied with the budget that has been announced today?
Yes, we are, because in terms of what it provides, as I said, from an international financial services perspective, not only this tax regime, but if you really ask me, there are 4 or 5 really important measures which come forward for the IFSC. So one is we already spoke of 20 years tax holiday. Second is the rate of 15%. Third is this deemed dividend, which we just spoke about in terms of clarification. Also that the MAT exposure architecture will not impact the IFSC remains protected, which is a very important step taken today. And this whole extended tech support for the foreign data centers and cloud services operations till 2047. I think the IFFC could also see a lot of tractions under that particular umbrella also within the IFFC zone, because the offshore data centers can be housed in the GIFT City, which will help avail those incentives also. And last but not the least, I think the capital goods exemption on the bonded toll manufacturing, supporting high-tech export manufacturing, can also be linked to the IFFC financing structure. So this could be a good way of utilizing the financial center for financing all those expanded ecosystem for capital goods and others, which can flow from this financial centers to India.
All right, Mr. Shah, thank you so much for joining with your views. And definitely, it is one of the way of government saying that GIFT City can be gateway of world. Thank you so much for your time.
Thank you.
With this, it's time to focus on the reactions which are coming in after Budget 2026, and what does Budget 2026 mean for Petroleum and Natural Gas Ministry. Union Minister Hardeep Singh Puri hails the budget and call it a budget of reform. Let's listen into an exclusive conversation with Minister.
Important thing, when the capital expenditure was 2 lakh crores in 2014, when my friends in the opposition were in office, and it went up to 11 lakh crores last year. Navika ji, I thought we've reached our limit. Will we be able to absorb 11 lakh crores? But no, we've not only absorbed it, we've raised the capital expenditure to 12.2 lakh crores. For somebody who's working in the energy sector like me, this is huge. This is the main visible manifestation of Reform Express. This is a budget which belongs to the Reform Express. This is a budget which caters to all, to the youth, to the students, to the farmers, to every sector. And that Reform Express exercise is what will determine how it will be finally viewed. Yes, it's a very intelligently done, both between part A and B. I think instead of saying, why can't you convince the opposition? I ask you a serious question. Are some of these gentlemen in the opposition who were once in government, do you think they want to be convinced? I don't think they're looking for that. What they're looking for is to make a criticism in the budget. If you can't come up with something else, say there is nothing in it for anybody. So when I read out to you what is in it for everywhere, I just read out. Now these outlays of 10,000 crores may seem small, but as my successor in the previous ministry, which I was privileged to associate with for 7 years, was telling you, look at the urban centers. Very clearly the Prime Minister's statement and the Finance Minister that urban centers are the growth area. Now, if you're concentrating on tier 2 and tier 3 cities, you will find that the employment generation, the growth, the demographics there will take off. And I had 5,000 crore for a CER. Of course, it will be through a challenge. There are many tier 2 and tier 3 cities. So I commend the budget. Not only what Nirmala ji has done overseas and her team have done.
Hardeep ji, on a realistic note, you will agree that our cities are quite broken at the municipal level. Governance is quite broken at that level. You know, middle classes pay a lot of taxes, but what they get in terms of the roads outside their house, you will give me the spiel about, oh, highways are being made, railways are being made, airports are being made. But look at the last mile.
I will give you no spiel. I will give you no spiel.
The last mile, and above all, the pollution issue. The pollution issue. Are we going to you know, consider these as issues that the government needs to focus on?
I think if you make the point, that the pollution issue needs to be addressed, we'll be the first one to agree with you, point one. But the pollution issue is being addressed. The state governments, as I heard one of the secretaries in the finance ministry say that, the state, it's essentially something the state has done. The center will also do it. Let me assure you on that. Insofar as the state of urbanization, municipalities, municipal bonds, I was very happy to see that 100 crore incentive given there. Look, we've come a long way. We've come a long way. We need to travel further. No, I'll give you some statistics. First of all, on municipal waste, in 2014, we were processing only 14-15%. Today, we are processing about 80%. It should be 100%. All right, there is a question of the Swachhta scheme has done very well. Yes, some roads are broken. Municipalities have to get off their, get their act together. I agree. Municipal reform is very important. It is being done. But the budget takes it further. This budget doesn't incentivize that. And my suggestion about middle class, I've been watching your program since the morning. You were echoing the views of some others, maybe more. Look, last year we took it from 4 lakhs to 12 lakhs. It can't happen everywhere. Well, you and I'm more middle class than you are. You're at least very well paid. So all I can turn around and say is that all good things, all in the fullness of time, and I think it's an excellent budget.
Okay, that's the word coming in from the Union Minister, Mr. Hardeep Singh Puri. But on that note, I'm afraid we're completely timed out on this special edition. From Ankur, me and the team that put this show together, thanks so much for tuning in. Stay tuned to ET Now for more news and updates.